In the intricate world of bookkeeping, accuracy is paramount. A single mistake can lead to a cascade of errors, potentially wreaking havoc on your financial records and causing headaches down the line. I've been doing bookkeeping since 1998 and began assisting multiple businesses beginning in 2002, and I have seen lots of data files with multiple issues. Sometimes it was better to start a fresh set of books. Other times, corrections were easier, but still time consuming. Whether you have someone assisting you or you are managing your own books, steering clear of typical pitfalls is essential for maintaining accuracy and financial health. Today, I want to share some of the most prevalent errors and how to avoid them.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
Number 1, your chart of accounts is set up wrong. The chart of accounts is the backbone of your accounting system, organizing your financial transactions into categories for reporting and analysis. This is a listing of any account you may use in your business, including assets, liabilities, equity, income, and expenses. Setting it up incorrectly, particularly misclassifying account types, can lead to significant issues. For example, designating an expense account as an asset or vice versa can distort your financial statements, making it challenging to assess your business's financial health accurately. To avoid this error, take the time to understand the purpose of each account type and assign them accordingly during the setup process. Another thing to understand is that there can be different types of accounts within one classification. For instance, assets will have bank accounts, current assets such as accounts receivable, and fixed assets such as fixtures and equipment. You can have current liabilities, including accounts payable, and long-term liabilities such as a loan. Generally, items directly related to revenue you generate are income accounts, but money you receive not earned from what you sell are other income accounts. The same holds true for expenses. For instance, if you earn cash back from a credit card and apply it as a statement credit, this should be classed as other income. Account numbers are not required, but if you're going to use them, be sure the sequence matches the type. Assets fall between $1,000 and $19.99. Liabilities $2,000 to $29.99, equity $3,000 to $39.99, revenue $4,000 to $49.99, and expenses start at $5,000. Other income and expenses usually start in the $6,000 range, but you can also split other income and other expenses into different ranges. Consult with your accounting professional if needed to ensure your chart of accounts accurately reflects your business's financial structure and reporting requirements. Mistake number 2, invoicing items are mapped incorrectly. Mapping invoicing items to the wrong accounts can have far-reaching consequences affecting revenue recognition, expense tracking, and financial analysis. For instance, if a product sale is mapped to a service revenue account, it can inflate service revenue and understate product sales, leading to misleading financial reports. This can affect sales tax reporting if you are reviewing your figures from your income statement to determine what is non-taxable, if services you sell are exempt. And you may not properly report your taxable sales to the state tax agency. To prevent this error, meticulously review your invoicing system setup, ensuring that each product or service is mapped to the correct account. You'll also want to think about how you will reflect reimbursed expenses on your reports. Do you want them to show as income, or do you want the expenses you incurred to be reduced by the reimbursements? If you are charging more for the product than you paid, you most likely want to have an income account to track these payments so your expense account doesn't show a negative value. However, if you purchase something for a client and are being reimbursed the purchase price, it's a pass-through expense, and you most likely would want to reduce the expense amount since it wasn't really a cost of your company and is not income earned. Regularly audit your invoicing procedures to catch any discrepancies and promptly rectify them to maintain accurate financial records. Mistake number 3. Failure to set up vendors for 1099 reporting. For businesses that engage independent contractors or vendors for services, proper 1099 reporting is crucial for tax compliance. Failing to designate vendors for 1099 reporting can result in penalties and scrutiny from tax authorities. Ensure that you collect W-9 forms from vendors and flag them appropriately in your accounting system for 1099 reporting. I recommend asking vendors to provide their W-9 form before you make your first payment to them. They may tell you they are a corporation and not subject to reporting, but request they provide the form to you anyway. They can certify their information, and if not subject, you would not have to issue a form to them. If you have to prove to the IRS why you didn't issue a 1099 form, you'll have the documentation you need showing your vendor certified they are an entity and not subject to reporting. Regularly review your vendor database to confirm that all relevant vendors are correctly identified for 1099 reporting, especially when onboarding new vendors or engaging in new business relationships. Mistake number 4. Duplicate customer or vendor names. Duplicate entries for customers or vendors can create confusion and inaccuracies in financial records. For example, issuing payments to a duplicate vendor name can lead to misallocated expenses and discrepancy in accounts payable balances. Implement robust naming conventions for customers and vendors to minimize the risk of duplicates and make every staff person who does any account creation aware of how to set up names properly. Regularly audit your customer and vendor databases, merging or eliminating duplicate entries as necessary to maintain clean and accurate records. Number 5. Incorrect sales tax rates on invoices. Accurately calculating and applying sales tax rates is essential for compliance with tax regulations. Using erroneous rates can result in the incorrect collection of taxes. If you undercollect, you are responsible for paying the difference. Failing to do so can lead to penalties and interest. Sales tax rates are based on where the client receives the goods or services. It's important to verify the rate of the location where the customer is located if they do not receive products or services in your physical location. Also keep in mind that new rates can go into effect throughout the year, not just on January 1st. Stay informed about changes to sales tax rates and regulations in your jurisdiction, as well as any location in which you sell and are subject to reporting, updating your invoicing system promptly to reflect these changes. Implement controls to verify the accuracy of sales tax calculation on invoices before they are issued to customers. And don't assume because you're selling in a different state than the one where you're located that you don't have to collect sales tax to remit to that state. Based on the value and number of transactions, you may be required to report in multiple states. Be sure to check the regulations of each state where you sell to ensure compliance. Mistake number 6. Sales tax information is misconfigured. In addition to using wrong sales tax rates, misconfiguring sales tax information, such as assigning the wrong tax agency, can lead to compliance issues and audit exposure. Review your sales tax settings regularly to ensure they align with current regulations and accurately reflect your business's tax obligations. Consult with professionals or use reputable tax software to help configure and maintain your sales tax settings accurately. As mentioned earlier, if you're selling out of state, you may be required to collect and remit sales tax to multiple jurisdictions. It's imperative that you can easily track what is due to each location, so be sure to set up sales tax rates properly and tax agencies correctly to easily identify what is due to each. Mistake number 7, improper recording of bills. Incorrectly recording bills and payments can distort accounts payable balances and affect cash flow management. For example, one mistake I often see is a bill being created, but when paid, the amount is posted to an expense rather than being applied to the open bill. This leaves a payable balance while doubling the amount of the expense. And even if the check is put to accounts payable, if not posted properly through the bill pay process, this can leave bills showing as open rather than paid in full. Another situation I've seen when new clients come to me is when a credit card payment is split by amount spent by category, so each purchase isn't entered. But if you need to go back and find a particular purchase, it's difficult since you can't search transactions by vendor. You'd have to review each statement until the item you need can be identified. And although it's not necessary for 1099 processing, since credit card transactions don't need to be reported by you, having transactions by vendor in your system is ideal. It will allow you to audit expenses over time and see how much is spent in a particular period by vendor. So my recommendation is to post every purchase individually, which increases the amount due shown on the balance sheet for your credit card. Then, when the bill is entered to pay the credit card, it reduces the liability amount. Establish standardized procedures for recording and marking bills as paid, including proper authorization and documentation processes. Train staff responsible for bill entry on these procedures and implement controls to detect and prevent duplicate or erroneous bill entries. Mistake number 8. Improper application of customer payments. Misapplying customer payments can result in misstated account balances skewing figures on your financial reports. If a client is paying a balance for an open invoice, it's necessary to receive payment against the invoice so it can be closed as paid in full. If they're making multiple payments, you will apply each received until the balance is zero. Failing to apply it to the correct invoice could leave it showing as unpaid, even if the customer account shows a zero balance due. Another instance that can result in erroneous posting is if a client pays for a service in advance. This should be posted against a liability account, as money can't be considered revenue until earned, and the funds are due back to the customer if agreed upon duties are not rendered. If you collect deposits from clients to be earned in the future, be sure you're using the correct item tied to the liability account when posting the payment. As an example, many of my clients pay 3 to 12 months in advance to receive a discount on service, but I can only claim income for the current period. I enter the payment to my prepaid services liability account, and each month we do the work, we offset the liability account through an invoice that captures the revenue we have earned. If you accept payments through third-party apps such as Square, Stripe, or PayPal, the amount deposited in your bank is less than the customer pays. You must properly record the amount the client remitted against the invoice and then reduce that by the fee withheld to match what appears in your bank account. Not following this procedure underreports the income earned and would result in an invoice showing a balance remaining. Implement proper procedures for payment application, including matching payments to invoices. Conduct regular reviews and reconciliations of accounts receivable to identify and correct any misapplied payments properly. Mistake number 9. Incorrect sales or credit memo postings. Misposting sales transactions, such as recording sales to the wrong accounts or periods, can distort revenue figures and incorrectly calculate sales tax liabilities. For example, If you're selling products that should be shown as revenue, but you're reducing the cost of purchasing the product, you would not be accruing sales tax on client invoices, which leads to underreporting sales tax, as well as reducing your total top-line revenue. It's important to enter sales into the right period so financial reports are not affected. For instance, if you've already filed a sales tax return for a period, you should not enter additional sales in that period unless you will amend the sales tax return. The error I find most often is when a business processes a credit memo and dates it back to the date of the original sale rather than creating it as of the current date. This can cause multiple issues, including affecting prior financial reports and sales tax reporting. Implement internal controls and reconciliation procedures to verify the accuracy of sales and credit memo postings, and be sure no transactions are posted to incorrect periods. Mistake number 10, miscategorization of transactions. Misclassifying transactions, such as categorizing a loan payment as an expense rather than a reduction of a liability, can distort financial statements and hinder decision-making processes. One mistake I often see is posting items that should be depreciated over multiple years as an expense instead of a fixed asset. If you are unsure if a purchase must be capitalized or if it can be deducted fully in the year of purchase, be sure to speak to your CPA for advice. Another situation where miscategorization can occur is when vendor names are not added to transactions imported from the bank. Because the description often has the company listed where the purchase was made, it is assumed a vendor name doesn't need to be added to the transaction. Failing to add the vendor name will make it impossible to run a report by vendor to see how much each was paid when it comes time to 1099 reporting. And as discussed earlier, failing to report vendor 1099s to the IRS can result in penalties. Provide training to staff responsible for transaction categorization, emphasizing the importance of accuracy and consistency. Implement regular reviews and audits of transaction categories to identify and correct any misclassifications promptly, and verify vendor names are listed on each. Mistake number 10, incorrect tax payment methods. Selecting the wrong method for paying sales or payroll taxes, such as using an incorrect tax form or remittance method, can result in compliance issues and penalties. Many businesses have quarterly sales tax filing requirements, but monthly prepayments are due. Be sure you post if the remittance is a prepayment towards the quarterly liability or the return payment if you are paying for a prior period balance. Select the right time frame for the payment to be applied correctly. When posting tax payments, make sure the correct form is selected. For instance, if using EFTPS, the Electronic Federal Tax Payment System, you may be scheduling estimated tax payments or payroll tax on forms 940 or 941. Selecting the wrong form could result in overpayment on one type of return and underpayment on another. It could take some time to correct if not reported correctly at the time the payment is made. Another error could be mailing a check when electronic payment is required. If you are required to electronically pay but fail to do so, a penalty can be assessed. Stay informed about tax payment options and requirements in your jurisdiction, seeking guidance from tax professionals. Double-check tax filing and payment amounts and due dates to ensure that they're accurate and compliant with regulatory compliance. Mistake number 12. Payroll items are misconfigured. Misconfiguring payroll items, such as using incorrect tax rates or employee classifications, can lead to discrepancies in employee compensation and tax withholdings. One error I've seen is setting up a deduction as a pre-tax item when it should be post-tax. This reduces the tax you withhold from staff as well as your own liability. When the error is caught by the tax agency, you'll have to pay the remaining tax balance plus interest and penalties. Each year, it's also important to review if the state unemployment rate or the maximum subject wage has been changed. This is one of the mistakes I see most often when companies handle their own payroll. They may not realize that the rates have been adjusted and they don't update the tax percentage or maximum wage for withholding in their payroll system, resulting in underpaid taxes. State agencies can take many months to catch the underreported amounts, but when they send a notice, you will have to pay the penalty and interest back to the date the balance was due. Also, check to see if any state in which you pay employees has a credit reduction of the FUTA tax. This occurs when states borrow funds from the federal government and don't pay them back on time. When this happens, the IRS reduces the credit you can claim for FUTA tax. Usually, the rate paid annually is 0.6%, but each year a state fails to pay back its loan, the rate increases by 0.3%. The states subject to this credit reduction are announced in November of each year. So regularly review and update payroll settings to reflect changes in tax laws and employment status. I recommend putting a reminder on your calendar for late December each year to check if the state for any employee on payroll has updated UI rates. Mistake 13, entries to closed accounting periods. Making entries to closed accounting periods can compromise the integrity of financial statements and affect the balances reported in prior periods. This is especially true for years that have had reports sent to the CPA for tax return preparation. Implement controls to prevent unauthorized entries to closed periods, such as restricting access to accounting software or requiring managerial approval for adjustments. Conduct regular reconciliations and reviews of financial records to detect and correct any unauthorized entries promptly. Once information has been sent to your CPA, close the books and require a password for any changes. And the only postings that should be done in a closed year are adjusting entries from your accountant to match your books to the returns filed. Mistake 14. Voiding or deleting checks from closed periods. Voiding or deleting checks from closed periods can disrupt financial records. When reconciling accounts, you may see open transactions that never cleared and should be removed from your books. However, voiding these transactions can affect prior periods and financial reports, so I recommend reversing them in the current period. Establish clear policies and procedures for handling checks from closed periods, including proper documentation and approvals for any adjustments. Implement controls to prevent unauthorized voiding or deletion of checks, such as restricting access to historical financial records. Mistake 15. Failure to reconcile bank, credit card, and loan accounts. Neglecting to reconcile bank, credit card, or loan accounts can lead to undetected errors and discrepancies in financial statements. Many think that because their accounts are linked in the software that this is a reconciliation, but it is not. To properly reconcile, you must match what is in your register to the statement, verifying all transactions have been posted. Software can sometimes have connection issues, and transactions may not import. And once the account is linked again, sometimes duplicated items are imported. So schedule regular reconciliations of bank, credit card, and loan accounts to verify the accuracy of account balances and transactions. Investigate and resolve any discrepancies promptly to ensure the integrity of your financial records. In summary, attention to detail and adherence to best practices are crucial for avoiding common accounting errors. By implementing robust internal controls, staying informed about regulatory changes, and conducting regular reviews and reconciliations, you can maintain accurate financial records and safeguard your business's financial health. If you need bookkeeping assistance, we are here to help. Reach out to us at 310-534-5577 or contact@abandp.com to start the process. We'll get some information about your business and have a discussion to determine what services are right for you. Whether you need only payroll assistance, bookkeeping, or both, we are here to help. I hope you found this episode informative. If you know of an entrepreneur who is struggling with the accuracy of their records, please share this with them so they can identify what they may be doing incorrectly and be able to make the change. Thank you. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.